EssProM EPM Simplified.
Hey everyone! Welcome back to the channel. In our previous video on financial consolidation in NetSuite planning and budgeting, we had seen how to consolidate an income statement. We have seen how all the P&L transactions were converted to its reporting currency and the intercompany transactions have been eliminated and finally consolidated to give you the consolidated profit after tax. In this video we will walk you through on how to conduct balance sheet consolidation in NSPB. So, let's get started. From the NSPB homepage, we shall select the budget card and click on Financial Consolidation to open the Consolidation configuration screen. In the Consolidation configuration screen, we can see the holding company as Westbridge Advisors and the different subsidiaries that are present under it. The subsidiaries are assigned with holding percentages as per business needs, as 100% for USA, 80% for India and 30% for Mauritius. Holding percentages for each subsidiary can be entered manually and the consolidation method is selected as subsidiary or equity. Generally, the equity method is selected for subsidiaries with a holding percentage 50% or less, but in this screen we have selected all consolidation method as subsidiary for demonstration purpose. Moving on to the next screen, the budget balance sheet consolidated screen. Here, the transaction amounts for individual subsidiaries are present in its local currency and the transactions that have been converted to its reporting currency. Intercompany transactions are eliminated and finally consolidated. Figures for all the different lines of asset, liability and equity shall be visible here. As we can see in the first two rows, the lines plant property and equipment and other non-current assets, the figures are present in its local currency which is then converted to its reporting currency. To understand how this currency conversion takes place, we shall go to the NSPB homepage and select the actual card to open the exchange rate screen. Just like we had seen in the previous video. The exchange rates are derived from NetSuite through integration that have been set from prior. It fetches the historical, current and average rates on a periodic basis for actuals, but for budget scenario the exchange rates can be manually entered, based on the requirements. Now, going back to the balance sheet consolidation screen, the holding company has made some transactions with the Mauritius, India, and USA subsidiaries. The amounts are then converted to its reporting currency. Since it is an intercompany transaction, the holding company is investing in a company of the same corporate group. Hence, the amounts are eliminated with a negative amount and finally at the consolidated level, the amounts turn out to be zero. Now let's understand how the goodwill is calculated. As each subsidiary makes some transactions, the sum of the amounts shall give the total investments by the holding company. This amount is then reduced by the amount of share capital of each company that have been invested in, multiplied by the holding percentage of each subsidiary. This shall give us the goodwill of the company. Here we can see there is an intercompany receivable from the Mauritius and India subsidiaries to the USA subsidiary, which is then converted to its reporting currency, and since it is an intercompany transaction, we are eliminating it with its negative amount to get zero at the consolidation level. Now we shall see the share capital and retained earnings under assets. The currency translations for share capital and retained earnings are happening based on the historical rates. After the amounts in local currency have been converted to its reporting currency, the sum of all the subsidiaries except the holding company is eliminated by its negative amount to neglect its impact on the total level to give the same amount of share capital in the consolidated level as you have for the holding company. Then comes equity before CTA or cumulative translation adjustment. The cumulative translation adjustment is calculated by reducing the total share capital of the subsidiaries from the total investments made by the company. Now we can see there is another intercompany transaction, as earlier the Mauritius and India subsidiaries had an intercompany receivable from the USA subsidiary. This amount is owed to the USA subsidiary and hence in the intercompany payables line the two subsidiaries are making a transaction which is then eliminated with its negative amount and consolidated to get its net impact as zero. Finally, we get the net asset as asset minus the total equity and liabilities. This is how we carry out balance sheet consolidations in NSPB. This is done to present the financial position and results of the entire corporate group as though it were a single entity. The consolidated balance sheet includes the assets, liabilities, and equity of both the parent company and its subsidiaries, but eliminates intercompany transactions and balances to avoid double counting. If you find this video helpful, then please like and subscribe to our channel. For more information, reach out to us at support@essprom.com. Thanks for watching.